Is FOMO, the fear of missing out, a good real estate buying strategy right now? Or should you sit on the sidelines and just wait for the crash? Well, I've got 3 things for you to consider why FOMO buying right now might be a smart move. And then I'll let you in on where to find the 4 most affordable metro housing markets in the United States, just in case you insist on a deal. And then I'll tell you why I finally broke down and bought my first primary residence, despite my own advice not to. And then I'll finish up with how I beat all the cutthroat buyers in the market without being outbid or overpaying. There's a lot here to unpack today, and I promise to be efficient as I show you how to buy a house in 2021. Let's go. EpicBreakthrough.com is the creative financing breakthrough real estate investors are looking for. Get started with a list of 21 creative financing terms and deal structure templates to invest in real estate using more of your mind and less of your money. Epic is changing the game. Start now for free at EpicBreakthrough.com. Hi, my name is Matt Theriault, CEO of Epic Real Estate, where we show people how to invest in real estate so they can escape the daily grind and retire early. And it's no news that the real estate market right now is, and for some time has been, particularly on the retail side, absolutely crazy. Everyone wants to know, when will this calm down? I mean, is this market insanity? Is it fueled by an authentic and sustainable demand? Or has the fear of missing out taken root and caused a buying frenzy that will inevitably crash and crash hard? Should you dive into the craziness and get whatever house you can? Or sit on the sidelines and wait for a dream home deal? Whatever your answer, I've got some stats that might cause you to rethink your situation. But first, let's check in where we are now with the National Association of Realtors' latest quarterly report. There's no big surprises here, as it shows the demand for homes continues, being driven by low inventory levels and record low mortgage rates. All but one of 183 markets have shown an increase in their median sales price this quarter. The report also revealed that 94% of markets experienced double-digit price increases, compared to 89% in the first quarter of this year. Since last year, the median sales price of single-family existing homes nationally rose almost 23%, and all regions saw double-digit year-over-year price growth. The Northeast, 21.8%, the South, 21%, the West, 20.9%, the Midwest, 17.1%. Now, the National Association of Realtors chief economist said that home price gains and the accompanying housing wealth accumulation have been spectacular over the past year, but are unlikely to be repeated in 2022. And he went on to say that there are signs of more supply reaching the market and some tapering of demand. Now, he didn't cite any sources for these 2 pieces of information, and I'll show you in a minute why they're probably insignificant anyway. Yoon did make a strong point for housing affordability, stating that for the first-time home buyer, it's weakening. The benefits of our historically low interest rates can't keep up with the rising prices of homes, thereby increasing the average monthly payment for the first-time home buyer in proportion to their median family income. Right now, the median home buyer's mortgage payment represents 16.5% of their household's income. A year ago, it was 14%, 2.5% less. Further, for first-time home buyers, the mortgage payment on a 10% down payment loan rose to 25% of their household income. When that number reaches more than 25%, it's typically deemed unaffordable by mortgage brokers. So this sounds like things are getting a little rough for first-time home buyers, and that the pendulum might finally be swinging back toward a more sane and stable market. So it sounds. But here's why it might not be enough to reverse direction for home prices. And there are 3 specific things that you're going to want to consider before deciding to wait for this bubble to pop or to dive in the deep end and buy. First thing, the supply. And I've covered it extensively here on the channel already. And in a nutshell, builders aren't building fast enough. At the current pace of approximately 1.5 million new homes being built a year, it would take more than a decade to close the supply gap just to normalize the retail market. Second, the demand. Now, despite what you hear in the media about the declining percentage of population growth, the total number of people is growing significantly year over year. And more importantly, it's the age distribution of the population that's likely to swing home prices one way or the other over the next 20 years. Here's what I mean. The peak population of our society today is 29 years old, just 2 years shy of the average age of the first-time home buyer, age 31. And there's a bigger generation, Gen Z, right behind them. So here's the deal. We don't have enough homes to house all of these people, nor are we building new ones fast enough.
Yeah, but Matt, this generation doesn't have nearly as much money as the previous generations. How are they going to buy a home at these rising prices? Something's got to give, right?
I get it. This is an argument that I hear frequently, and I'm not sure whether this generation has less money or not. No one has really been able to show it to me. Either way though, it's a sweeping generalization, and even if it is true, it might not matter. Here's why. Today's repeat home buyer has an average FICO score of 740. The average first-time buyer's FICO is 725. These are strong buyers. Further, the average back-end debt-to-income ratio is falling for both repeat and first-time home buyers alike. And what's more is, their mortgage payment represents the smallest portion of their disposable income that we've ever seen. If it's true that millennials don't have the money to keep up with rising home prices, their parents do, at least for a while. And here's why that's important. Because today's home buyer isn't stopping at buying just one. A November headline on Barron's.com reads, "Second homes are driving the U.S.'s COVID-19 housing boom." A December story in the Washington Post reports, "Second home market surges." And just in June on CNN.com, people are snatching up vacation homes, and many are paying with cash. The demand is strong. Buyers have got cash, they've got credit, and their debt is shrinking. So do you see what's going on here? Despite what you think about rising housing prices and the real estate market, it doesn't seem to care. It's gonna do what it's gonna do. And when demand is outpacing supply at such a strong and rapid rate, many more will get priced out of the market. But wait, there's more. The third thing to consider. Inflation. And I understand this is a wild card. It could go either way long term, but it's going really strong in one specific direction right now, and that's straight up. And if it continues, there's only one real way to stay out in front of it, and that's by using long-term fixed debt to invest in cash producing and or inflation appreciating assets. For the average person, that means real estate. Now, you can wait for the market to shift before you buy, and I don't think anyone would think that you're foolish for doing so. But you could be waiting a very long time, perhaps indefinitely. It's not probable, but it's possible. This is one thing I know. If you were to pick any period in modern history where a house was purchased and waited 20 years, regardless of what year that house was purchased, that person would be better off than had they not. Historically speaking, the average homeowner is 40 times wealthier than the average non-homeowner. So those are the facts. Do with them what you wish. And I'll tell you what I did and what I'm doing in just a second. But in this National Association of Realtors report, despite showing how much prices have increased, it did show 4 metro areas where you need $25,000 or less to buy a home, and more specifically, where the average family can afford to finance a home with a 10% down payment. Number 1, the Rust Belt areas of Youngstown, Warren, Boardman, Ohio. You need $24,401 to afford a home in this area. According to Zillow, the average home price here is $127,274. And 2 of the largest employers in this metro area include General Motors and the U.S. Postal Service. Number 2, Peoria, Illinois. To afford a home in this town, you would need $24,013. The average home price is about $100,085, according to Zillow. Caterpillar is one of the largest employers in Greater Peoria. Number 3, Cumberland, Maryland. You could afford a home in this town with about $23,773. The average home price in Cumberland is $103,449, according to Zillow. Started as a railroad town, it's manufacturing, coal mining, and outdoor recreation that now drives the city's economy. And number 4, Decatur, Illinois. To afford a home indicator, you would need $21,481. The average home price is $84,428 according to Zillow. Known as a major soybean processor in the 1900s, the largest employer in the town is now Archer Daniels Midland Company. Now, I've never been to any of these places, but now you at least know where they are. So with all this data, what is there to do? Well, I don't know. You do what you feel is right for you, but here's what I did and here's what I'm doing. Despite a decade's worth of podcasts and videos shouting from the rooftops that your primary residence is the worst performing asset in America, and I still believe that to be true, but I did just buy my first home. And here's why. My advice to not buy your primary residence and rent instead always did come with one caveat, and that was to buy your home as long as it is cheaper on a monthly basis than renting. Now, that might not mean much to you depending on where you live, but I've never lived anywhere where that was even possible. So I could always live in a much nicer home for a much cheaper monthly amount while my income properties footed the bill. It was my income properties that paid my rent. This year, median rents nationally rose 8%, and the median rents here in Las Vegas, where I live now, increased by 23%. The rents here for your average home have gotten pretty close to the mortgage payments. What's worse, bidding wars here aren't exclusive to home sales. Nope, they're happening with home rentals too. And it got to the point that if I wanted to stay in a reasonably nice home where I felt my family was safe, it was going to be cheaper for me to buy than it was to rent. So I bought. Now, the part you've probably been waiting for. How did I compete against all the bloodthirsty, cash-rich buyers without being outbid and overpaying? Pretty simple, actually. You see, when we submitted our first offer, we were one of 20 on this particular home. Needless to say, we didn't get that one. Our agent said, that's how it is, get used to it and just kind of wait for your turn. Well, I found that explanation completely unacceptable. So I decided to flip the script on the sellers. And I picked out 10 houses that I found to be reasonable places to live, even if they were going to be temporary. And I wrote 10 full price offers for houses, sight unseen, and I did that all on one day. So we received 4 replies, 2 counteroffers where they had asked us to remove our appraisal contingency. I said no thank you to them, and then the other 2 were actually accepted. So we toured those 2. We picked our favorite, and per the inspection contingency in our purchase agreement, I canceled the other one. So we were in escrow within a week without paying a single dime over asking price. See, the sellers in the market are playing nasty games, pitting buyers against each other. So I played my own game, and here we are, home sweet home. And I'll be submitting 10 more offers tomorrow to pick up my next one. So sure, I've got a little FOMO going on, but it's fear based on data, on a growing demand that's outpacing supply, both in sales and in rents, based on historically low interest rates and inflation rising more than twice the normal rate. So for now, I think FOMO executed correctly wins in the long run. But what do you think? What did you find most valuable? What would you do? I don't know, let me know below. And who else do you know that needs to see this? When their name comes to mind, please share it with them. Oh, and if you're already subscribed, I pulled this video out here special for you to watch next. Otherwise, I'll see you next time. Thanks for watching. Take care.